When a $3 trillion AI company sneezes, the market catches a cold. Likewise, when they make an investment, everyone takes notice. We first started covering NVIDIA when they were valued at less than $40 billion. Now that's about what they bring in every quarter. And several months ago, they made an investment in a company called Applied Digital, or APLD stock. So is Applied Digital ready to show explosive growth, or is this just another manifestation of AI hype? Today we're going to help you better understand a company that's attracted both bulls and bears. So the pundits out there love the clickbait headlines. This one from Guru Focus, NVIDIA's $63 million move. Applied Digital soars over 5% on game-changing AI stake. Well, how exactly has the game changed? So when they talk about NVIDIA's AI investments, they're referring to the 13F filing. So this first took place in February of 2024. The reason that NVIDIA started filing these documents is because you need to file these when you have at least $100 million in assets under management, and their investment in ARM meant that they did. So after that IPO, they started filing these documents. And here you can see on the bottom, this is February of 2024, the first filing. And then you can see the most recent filing in November of 2024. And look, there's an extra company there. It's Applied Digital Corp. And what you want to pay attention to here would be the number of shares. You can just multiply that by the current share price and get the current value of NVIDIA's investments, so around $61.7 million. In the context of the amount of cash NVIDIA has, and in the context of their other investments, this isn't really that big of a deal. So when you look at NVIDIA's investments, you always need to put them in context. We've done that in the past. Well, most recently looking at SoundHound. Most of these investments were grandfathered in from older investments that NVIDIA made, so people tried to spin these as something NVIDIA is doing right now, and in fact a lot of these were older. The Applied Digital investment is actually relatively new. And when a very large tech firm makes an equity investment in one of their customers that heavily relies upon them, take that with a grain of salt. And I think a good example would be all the EV companies that Amazon was investing in. Walmart does the same thing, so they'll make these large equity investments into companies that appear large from the company's perspective but aren't really that big in the bigger picture. What seems to be happening is that companies are recognizing the marketing value of having NVIDIA as an investor and the subsequent valuation jump that comes with an NVIDIA investment. So let's talk about valuation, because that's very important. So when we look at Applied Digital Corporation, what we can do is use that last investment as a benchmark. So they sold 49 million shares roughly at a purchase price of $3.2 a share. So that roughly represents the $160 million investment that they took from investors, including NVIDIA. And when you look at shares outstanding, this is very important. It's something that retail investors don't really pay attention to because it's not so obvious. Massive dilution for Applied Digital over the years. So from May of 2022 until today, and we've simply estimated what that dilution looks like after that most recent investment. All things being equal, the value of your shares would have halved in 2.5 years. That's because the equity you're holding would have halved. So you need to be very careful about this. And when you see articles like this, it says from Insider Monkey, why Applied Digital is one of the best AI stocks to invest in under $10. This is a big pet peeve of mine. The value of a stock is not based on the price of the stock. That's a huge amateur hour error that you shouldn't see coming from financial pundits. It's total rubbish because the price of a stock has nothing to do with the valuation. At the present price of $8 a share, remember you're paying a 146% premium to what investors like NVIDIA just paid months ago. But if we want to look at valuation, it's important to use a metric that can be applied across all tech companies. We use what's called a simple valuation ratio. This is a take on price to sales. We simply take last quarter and annualize that. That means multiply it by 4. So Applied Digital had a market cap of $1.69 billion. Their last quarter revenues times 4 would be $244 million. We divide those two out and they have a simple valuation ratio of 7. That's not overvalued based on our catalog average of 6. So where we start to have concerns with Applied Digital is in their shell roots. And the original IPO of this company back in August of 2021, you can see here all the mentions of crypto. So they were going after the latest and greatest thing. And when you look at the past of this firm, it just has more red flags than a Chinese military parade. Whenever you see a company that's pivoting, especially a shell company, into various directions based on what they're trying to find where they belong, here you can see they started out providing staffing services to film, video, and TV producers. Then they changed their name to Flight Safety Technologies, then changed their name to Applied Science Products. Then they were deemed a shell company and nothing happened for a long time. Then they started investigating opportunities to acquire or otherwise build an operating business. This is just not how successful companies get built. We've seen dozens, hundreds of shell companies over the years, and I can't think of one that ended up being the big success story that management promised. I think SPACs are probably the best evidence of that. We were warning on them since they reared their ugly heads. So then you see where they decided they were going to build a business focused on crypto assets and participate in Ethereum mining. And they entered into a services agreement with this British Virgin Islands company called Sparkpool. Well, in June of 2022, Sparkpool ceased all operations, and then Applied Digital changed their name from Applied Blockchain to Applied Digital Corporation. And there we sit today. And they've embraced these pivots. You see this article on the website, from potatoes to AI. And it's this, pull yourself up from your bootstraps and build something great story from a guy who's from southern Idaho. I'm from Idaho myself, and I appreciate the story he's trying to tell, but I don't appreciate the past of this company and how it's always chasing the next greatest thing. They're trying to spin that as a positive. It's not at all. Now, when they had that IPO, there were some concerns there. And look, there's several short reports out there. I haven't read them. I imagine they're going to raise the red flags that we have today and probably others. So if you're an investor, you owe it to yourself to read through those. Where there's smoke, there's fire. If you really feel this is a compelling company, you want to read the biggest bear thesis you can find. And that's always in short reports. You have, I think, two different ones to read here. But this is from Bloomberg. Applied Digital is being sued over ties to their IPO underwriter, B. Riley, and that's because the CEO of Applied Digital used to have a leadership position at B. Riley, and you can read the lawsuit yourself. I think any investor ought to, and where we probably have some concerns would be when they talk about how they claim Applied Digital overstated the profitability of its data center hosting business and its ability to successfully transition into a low-cost AI cloud services provider. So how is it going so far? Well, these constant past pivots and chasing what's hot, it's a big red flag. Rarely does anything good come out of a shell company. The legal confrontations appear to be more than just ambulance chasing, and you can monitor these in the 10K and 10Q. They'll tell you what progress is being made or not. The NVIDIA investment's being lauded as a great thing when it really isn't significant for NVIDIA. Take it with a grain of salt. The current share price is trading at a huge premium to what the private placement was offered at, but it wouldn't be considered overvalued by traditional valuation metrics. I think we're probably one red flag away from a showstopper here where we wouldn't consider investing. We'll get to that. But what about that profitability question? Well, when you look at their financials here, you can see that they're just dreadful. What they're doing here is including depreciation and amortization in COGS. I don't know why companies do this. I spent a fair amount of time trying to research the benefits. It seems like it's a downside because you'd want to show proper gross margins, and companies don't typically engage in this practice because it complicates the cost structure. So if we back that out for last year, they would have had a gross margin of less than 30%. So that's not as attractive as a software business. But we're going to talk a little bit about the business model they're trying to get into. And guess what? Those gross margins are going to see a lot of pressure over time from large cloud providers and other firms that are operating at a much bigger scale than Applied Digital is. Now, when we look at the two primary revenue segments, you see this data center hosting business providing energized space to crypto mining customers, and they provide operational maintenance services for a fixed fee. Well, if you want exposure to that, invest in their competitors, Digital Realty and Equinix. These are much larger firms. We've covered them in a past piece. We don't find the business models of those firms to be overly compelling, but you may come to a different conclusion. Then you have the cloud services segment, and that's where customers are going to pay them a fixed rate in exchange for an energized space supported by company-provided equipment. So that's going to take a lot of capital to build that up, and that's what they're having to do, is raise capital to pursue that particular business model. Here you can see their strategic shift into GPUs as a service. Of course, they try to say that they were doing that prior to ChatGPT gaining popularity. Well, based based on what we've seen with this company, they're chasing whatever seems to be up and coming. Who knows what their next pivot will be, but it seems to be GPUs as a service is the way forward. Now, probably the last red flag for us, which is a definite showstopper, would be concentration risk. I've spelled that out here. For last quarter, you can see that over 60% of revenues came from two customers, or nearly half of revenues from one customer. That's not going to work for us. And then I've also spelt out the customer concentration risk over the past several years. You see that it persists. Now, we should see these risks evaporate as the company scales, and we're happy to wait for that to happen. Now, cash flows, I think when you look at their cash flow statements, this is important to do. So they didn't have much cash as of the end of last year, just $31 million. And then they raised cash through financing activities. Last quarter ended with $86 million. And then, of course, you have the private placement NVIDIA participated in. And then you have this $370 million convertible notes offering at 2.75%. I know they had $100 million in debt that was at a much higher rate than that averaged. So presumably they're going to replace that with this note. It's not a ton of money, but it certainly will help them build out their business model. So some thoughts here. Companies past and their customer concentration risk, I mean, all that means that this is a showstopper for us. We wouldn't consider investing in the company. We'd avoid it until some of these red flags cleared up. The thesis is to raise a whole bunch of capital and operate profitable data centers. Now, economies of scale are going to help data center operators compete on cost. And build it and they will come propositions. Another we looked at recently was Nebius. They're starting at a disadvantage. You look at firms like CoreWeave. They took in $12 billion in equity and debt. Crusoe Energy, $1.5 billion. Lambda, $500 million. So they're all ahead of the game. And I also have questions about the sustainability of these models. So there's a great piece here by The Next Platform that talks about how you can make more money renting a GPU than NVIDIA makes selling it. And they put together this diagram. And for those that are perusing collateral from Applied Digital, you can use this statement to sort of run some basic math. It says 16,000 NVIDIA H100s would cost around $1.5 billion to purchase, deploy, and network, but they could make over $5 billion in revenues in just 4 years. That's the whole appeal of this business model that's being pursued by venture capitalists with a lot of cash. And then you have, of course, Applied Digital trying to play in this game as well. We look at CoreWeave, probably the leader. They claim to be up to 80% less expensive than large public clouds. How is this possible? So I asked various LLMs and they provided some answers. Nothing was that compelling. I'd love to hear comments from our audience on how they believe that this business model is sustainable or how there's any sort of moat here. So the reasons given by LLMs, you pay only for the resources you use. Well, that's a business model change. CoreWeave's infrastructure designed to maximize resource utilization. Well, anybody can do that, right? They can optimize their offering for various use cases. Again, business model change. They don't charge for data transfer in most use cases. Business model change. Direct access to high-end GPUs from NVIDIA. Well, everything is all about demand right now. But once all this infrastructure gets put in place and you start to see demand wane, then what happens to this business model? Not seeing much of a moat here. And I think that leaders are going to dominate through economies of scale. So perhaps CoreWeave, perhaps large cloud providers, but certainly I don't think Applied Digital trying to play catch up and pivot their way into the next great thing is an overly compelling thesis. Now, I'm going to go ahead and leave you with another video that we did that's worth watching. It's on Nebius. So they're a firm that's doing something similar, and they're certainly more compelling because they're working with a lot more cash. So give that a watch next. See what you think. Thanks so much for taking the time to watch this video today.